You wake up and your AI stocks are green again. By lunch, one earnings call mentions slower growth, and your portfolio looks like it fell down an elevator shaft. The technology did not disappear. The robots did not resign. So what exactly just broke? The answer is not artificial intelligence. It is the price investors were willing to pay for a future that had not arrived yet. A stock price is not a medal for what a company has already built. It is a compressed estimate of profits that may arrive years from now. When expectations rise faster than those future profits can realistically grow, the story becomes more valuable than business underneath it. What happens when the story finally misses a number? That is how an AI stock bubble would begin to break. Not with one dramatic announcement that artificial intelligence was fake, but with a smaller sentence buried inside an earnings call. Revenue grew, but not fast enough. A data center opened, but the return on that spending looked vague. A chipmaker delivered record profits. Yet investors had already paid for something even more spectacular. How do you impress a market that is priced in perfection? By mid-2026, that question matters far beyond a few technology traders. Information technology represented about 38% of the S&P 500, and the 10 largest companies represented roughly 36% of the entire index. In a major U.S. technology index, the top 10 holdings made up about 2/3 of the portfolio. Your broad market fund may look diversified, but a surprising amount of its daily movement can still depend on a small collection of giant companies. Are you holding the whole market, or a technology story wearing a diversified costume? The spending behind that story is enormous. Microsoft, Alphabet, Amazon, and Meta were expected to spend more than $600 billion during 2026 on data centers and other infrastructure tied to artificial intelligence. Capital expenditure means money used to build long-term assets such as servers, chips, power systems, and buildings. That spending can create future profits, but it creates real bills today. What if the profits arrive 5 years later than the invoices? A bubble forms when a real innovation meets unrealistic timing. Economist Hyman Minsky described financial cycles in which stability encourages people to take more risk. Rising prices validate that risk, and borrowed money pushes the system even further. The early buyers look intelligent. The late buyers copy them. Eventually, the price depends less on business results and more on finding someone willing to believe an even larger story. When does confidence become a payment system? Robert Shiller called this kind of process irrational exuberance. His work showed how narratives, social imitation, and feedback loops can pull prices away from sober estimates of value. A rising AI stock becomes evidence that AI stocks deserve to rise, which attracts more money, which pushes prices higher, which creates even better evidence for the people who arrived last week. Your screen is not merely reporting enthusiasm, it is manufacturing it. How long can a loop congratulate itself? Then something ordinary happens. A company guides future sales slightly lower. A cloud provider says customers are testing AI tools, but have not expanded spending as quickly as expected. Electricity costs rise. New chips sit unused for longer than planned. None of these events needs to destroy artificial intelligence, because a bubble does not require the technology to fail. It only requires reality to arrive below the price. The first stage is a valuation shock. Valuation means the price investors place on each dollar of expected profit. When investors believe growth will remain extraordinary, they may pay an extraordinary price for earnings that are still years away. If that growth forecast falls from spectacular to merely excellent, the business can improve while the stock collapses. Can a company succeed while its shareholders lose money? The dot-com crash already answered that question. The internet was not a fraud. Online shopping, digital advertising, cloud software, and global communication eventually became larger than the most enthusiastic investors imagined. Yet, after the Nasdaq peaked in March 2000, the index lost roughly 4/5 of its value before reaching its 2002 low. The technology changed the world, but the price had tried to change the world several decades in advance. Which one was wrong? The internet or the invoice? That distinction is the most important part of an AI crash. Artificial intelligence could transform medicine, logistics, programming, manufacturing, and education, while many AI-related investments still produce terrible returns. A brilliant technology does not automatically create a brilliant stock at every price. Benjamin Graham described the market as a voting machine in the short run and a weighing machine in the long run. What happens when the weighing finally begins? The second stage is index contagion. Contagion means losses spreading from one area into investments that appeared separate. Imagine you own $100 in a fund tracking the S&P 500, and its 10 largest companies represent about 36% of the fund. Well, if those 10 holdings fell 40% while everything else stayed unchanged, they would subtract roughly 14 percentage points from your portfolio. Would your supposedly boring index fund still feel unrelated to the AI trade? Everything else would probably not stay unchanged. When giant stocks fall, index funds decline, retirement accounts shrink, and investors become less willing to take risk anywhere. Funds facing withdrawals may sell healthy assets simply to raise cash. Leveraged traders, meaning investors using borrowed money to enlarge positions, may be forced to sell after prices fall. Why does a problem in expensive chip stocks suddenly reach banks, industrial companies, and your retirement statement? Because market value affects behavior. When your portfolio rises, you feel richer and may spend more. When it falls, you delay the new car, the vacation, or the home renovation. Companies react to a lower share price, makes stock-based employee compensation less attractive, and makes acquisitions harder to finance. The crash begins on a screen, but where does it travel next? The third stage is the capital spending hangover. During the boom, technology companies order chips, construct data centers, sign power contracts, hire engineers, and promise that demand will catch up. Suppliers expand to serve them. Utilities build capacity. Real estate developers prepare land. What happens if the largest buyers suddenly decide they already own enough servers? Orders slow first. Semiconductor manufacturers cut production plans. Data center contractors lose projects. Power equipment suppliers watch backlogs shrink. Startups that expected cheap computing and endless venture funding discover that both have become expensive. The AI bubble may look digital, but the layoffs can be painfully physical. The fourth stage reaches credit. Credit is borrowed money that must be repaid, regardless of whether the exciting future arrives on schedule. During a boom, lenders accept optimistic forecasts because asset prices keep rising and refinancing looks easy. After the break, the same lender asks for cash flow, collateral, and a plan that contains fewer rockets. What happens to a company built for permanent optimism when the bank develops a personality? Weak firms fail, stronger firms cancel projects. Investors demand profits now instead of market share later. Private companies accept lower valuations, meaning their paper worth is marked down even before their shares trade publicly. Employees discover that stock options can become souvenirs from a company retreat. Is this the moment when innovation stops? Probably not. This is the counterintuitive twist. The crash may punish AI stocks while making artificial intelligence cheaper and easier to use. Bankrupt companies sell servers, talent moves to healthier firms, chip prices soften, and managers finally learn which products customers will actually pay for. The financial bubble can deflate while the useful technology spreads. That happened after the dot-com collapse. The wreckage included empty offices, failed companies, and fiber optic networks built for demand that had not yet arrived. Those networks did not evaporate. Later, businesses used the cheaper infrastructure to build services that looked impossible during the boom. Could an AI crash create the same strange gift? The winners after a bubble are rarely obvious before it breaks. Some celebrated leaders remain important. Others spend too much, issue too many shares, or discover that their advantage was temporary. A smaller competitor may survive because it has cash and patient customers. The company selling electricity, cooling equipment, cybersecurity, or specialized software may earn steadier profits than the company selling a grand vision of artificial general intelligence. Are you investing in the loudest story or the strongest economics? Now reconstruct your own crash. You bought an AI stock after watching it rise 150%. You told yourself the position was long-term, but you checked it 12 times a day, which is a fascinating definition of long-term. The stock falls 20% after earnings, then another 15% when analysts reduce forecasts. What do you do when your conviction loses exactly the same percentage as your money? If you borrowed to buy it, your choices may disappear. If it represents half your portfolio, fear may control the decision. If you need the money next year, the market may force you to sell before the business has time to recover. Risk is not only the chance that an asset falls, it is the chance that the fall arrives when your life cannot wait. How much volatility can your actual bank account survive? A defensive plan is less exciting. Keep emergency cash outside the stock market. Avoid using debt to chase a theme. Limit any single company or narrow sector to an amount that can fall without rewriting your future. Rebalance, which means periodically returning your investments to their intended proportions, instead of allowing the hottest winner to consume the portfolio. Why does basic risk management become visible only after the fire starts? Diversification also needs inspection. Owning several funds does not help much if all of them hold the same giant AI companies. A technology fund, growth fund, large company fund, and broad market fund can look like 4 investments while repeating many of the same names. Check the largest holdings and sector weights, rather than counting account statements. Are you diversified by label or by actual economic exposure? None of this tells you exactly when a bubble will burst. Schiller warned about excessive technology valuations before the 2000 peak, yet enthusiasm continued long enough to punish anyone who assumed being early was the same as being wrong. John Maynard Keynes is often associated with the lesson that markets can remain irrational longer than traders can. Remain financially secure. A warning is not a calendar. Can you build a portfolio that does not require a perfect prediction? That is the practical advantage. You do not need to prove that every AI stock is overpriced. You do not need to call the top. You only need to refuse a plan that works exclusively while prices rise. When the AI stock bubble finally breaks, will your strategy require the market to apologize? The screen will turn red. Commentators will announce that artificial intelligence is finished, just as earlier commentators announced that every company adding the letters AI deserved a higher valuation. Both claims will be too simple. The technology will continue, the weak economics will be exposed, and patient capital will begin separating useful businesses from expensive stories. You wake up, and your AI stocks are no longer green, but now you understand what actually broke. Not the future, only the price that tried to arrive there first.